Hey, welcome back to the Road to Retirement. My name is Chris Anselmo, Brookside Tax and Financial Group, and joining me is Tony Marlette Jr. from our office. I don't know where T2 is. He must be on vacation or something up in Minnesota, but we'll miss him today. It's cold here today, so it might be snowing in Minnesota today.
Always with the Minnesota references.
Yeah. Yeah. Well, at least somebody gets more snow than us, right? So, but it's good. Yeah. Unfortunately, we're broadcasting on a day that we hope that our baseball team will win a game so we could keep going. So we've taken it on the chin the last couple of days. So
yeah, I hope so too. I think when you're not scoring.
Yeah, you just score any runs.
Scoring, you're not. It's hard to break out of that and all of a sudden rattle off a bunch of wins. So you take it one game at a time, but at the same time, we're going to be looking at this in the future, and we may look stupid right now by saying this, but it just doesn't look too good.
Yeah. Well, hopefully they win today, and at least they'll get to a game 5. But so I thought today we use a lot of terminology in our industry and a lot of different indices. So people hear the different indexes like the S&P 500, the NASDAQ, all that kind of stuff. And, for us, it's kind of commonplace, but I'm not sure if a lot of clients know what these indices are, or index. I guess it's indices, but a lot of people call them indexes.
Potato.
Yeah. So I would think that maybe we'll go over the more common ones and just, we don't have to give them the technical definition, but we can explain what they represent and why we use those and the diversification and things like that. So,
the big one, the main one is when people refer to the market, usually they're referring to the S&P 500. That's
or the Dow, right?
Well, it's mainly the market is the S&P 500.
Right.
But the Dow and the S&P 500 are both U.S. indexes, 500 largest companies for the S&P 500. Technically, it's weighted out by market cap.
Right.
So, you take all the market caps, add it together, and that's where you come up with the 5,900 value that the S&P is at.
So the S&P stands for Standard & Poor's as a rating agency. So they kind of rank and rate the companies that are involved in the S&P 500. And the S&P 500 is a pretty good measure of the overall economy, I would say. It has, but we saw in the last year or 2 or 3 years that a lot of times the S&P is dominated by, a dozen firms, a dozen companies or so.
Yeah.
So
we've seen that, and this year it started to level out. So since July, the other 493 companies, there's more than 500 in there, but let's just say the 493 are actually positive, and the Magnificent Seven is actually negative. That's just since July of this year, but it is starting to normalize and turn into more of a broad-based index.
Yeah, and there are some indexes or funds or ETFs that we could pick, maybe the S&P 100 or 50 or things like that. So we could narrow down if you want to just play with the big boys. But it is a way of getting diversified if you just pick an S&P 500 fund or index fund. So oftentimes we use those because if your portfolio is not, I don't say the right word, not large enough to where you can buy 100 or 200 stocks, it's hard to get diversified. So this is an easier way to get diversified. And it's the one benchmark that most money managers are shooting to beat on an annual basis. Can we keep up with the S&P 500, or God forbid, if we have a negative year, do we lose less than the S&P 500?
Right. And like you said, there's different variations of it. There's the S&P 600 too, which is mid and small cap companies. It's not the main mid and small cap index, but there's so many different. There's weighted S&P 500 where, if you're investing in a normal S&P 500 fund, they're going to invest just like the weights in the actual index. Whereas if you invest in something that's called equally weighted, they give equal weight to all 500 of the companies. And then that's in those situations, that equally weighted fund will perform better when the market is more broad.
Right. And the other one, the one you hear in the news a lot is the Dow Jones industrials. personally, I don't think that's, look, they've always used it, but I don't think it's really good measure because it's really just 30 companies from year to year, and they change from year to year. We could
Sure.
probably call up a list of who's the big names in the Dow Jones this year. But that's the number you always hear on TV. The Dow hit 30,000, 40,000, whatever it was. But again, I think the S&P 500 is the one I would look at more than the Dow Jones, because I would think most people even listening don't realize it's only 30 companies.
Right. Yeah. 30 companies. And like you said, they're big companies too. Yeah. So it's not really.
Do you have anything where you can name off a few for our listeners who's in the, it's probably like IBM and Google. I don't know if Google's in there, but it's usually the major companies, right?
Yeah, it is. So, I mean, you have some big, like it'd be funny to pull up something where
20 years ago.
20 years ago, what were some of the companies that were in there versus today? I mean, you're going to have Google and Amazon and all that, Ford.
And you're going to have IBM and I don't even know if Sherwin-Williams makes it anymore, but some of the really ones that are the stalwarts of the U.S. economy. But again, it's just 30 companies, so it's not a great indication of the overall economy. Now, for smaller companies, which indexes do we use? Russell or the NASDAQ?
Yeah, I think the Russell is the big one. The NASDAQ does have some small companies in there. The NASDAQ is deemed usually to be more tech heavy. You do have some non-techs. There's financials in there too. But on the NASDAQ, you do have some smaller, less known companies. But mainly the Russell 2000 is the main small cap index. And the thing I really like about the small cap index as opposed to small cap companies by themselves, it's broad based. And if you invest in just say Cisco, which is not a small company, that's on the S&P 500, you're fairly confident that it's a relatively safe bet. But if you take any of the companies in the Russell 2000 and just invest in them by themselves, you're taking on quite a bit of risk.
Yeah.
But if you diversify across the index, you're going to get a lot of exposure, and it can be very high reward. It can be high risk, but it can be very high reward. Small caps are known for benefiting in times like now when interest rates drop. And it makes sense because small companies need capital. They can borrow some of the
up and coming innovative companies, maybe going into different sectors of the economy. But like Tony said, picking any one of them, investing directly in one of those might be taking a little more risk than you should or want. So the Russell 200 or 2000 is a way to again diversify among those companies, and it generally is the tech sector, the financial sector, the up and coming sectors. It's not a lot of industrials in there or anything like that. So
right, and each of these indexes, it's important to note, they do have ETFs that you can invest in that will mirror the index. One of my favorite examples of this is QQQ, which is the NASDAQ. So this is not an investment recommendation, by the way, but QQQ follows the NASDAQ. There's even a next 50 NASDAQ index that tracks like the next 50. The NASDAQ is made up of 100 companies. And again, it's tech heavy. There's some financials and there's some speculative ones in there. So you get a little bit more exposure in there. And the next 50 is theoretically the next 50 companies that are ready to join the NASDAQ based on numbers and how they compare with what's currently in there.
It's QQQN or something like that, or something like that. So, so the NASDAQ, tell us a little bit more about the NASDAQ. What do you see there?
So you get market cap weighted index, just like the S&P 500. And then smaller companies, tech dominated, software, biotech. There's some financials in there, and again, some speculative as well.
Are they on different stock exchanges too, or are they just everything's on the New York Stock Exchange? Or
so they're their own exchange, the NASDAQ. So, but you do have some overlap if that's what you're asking. Yes. Yep.
There's also some non-U.S. ones like the euro and the Euro Stock 50, and there's a few that I think we sprinkle in from time to time just to get some exposure, because not all the great, and look, we have a lot of great companies in this country, but there's also great companies in Europe, right? So if you want a little bit of exposure there, it might be, well, instead of picking individual companies, maybe you pick some of the European indexes, and at least you get some diversification in those companies.
You got to watch. You have a little bit of added risk when you invest in those, because depending on how small the companies are and what country they're located in, you have a fair amount of legislative risk and regulatory risk involved. So
so
that's why we don't ever go too deep and too saturate somebody's portfolio too much with something like that,
because they're not regulated by the SEC. They're not regulated by the U.S.
Right.
That Regina's calling me. She should know we're on the radio, or we're on TV, or YouTube, or whatever.
You got to turn your ringer down. Turn your ringtone down.
I don't know. Everybody wants me, right? So,
you're way more in demand than I am. I don't have that issue.
And then there are some emerging market indexes. Those are the really the startups or the industries that are, you think about all the green economy, those type of companies that are coming about, and they'll take a while for those companies to get to fruition. And then if they get big enough, then they usually jump to one of the other indexes.
Jump in the other indexes. That's right. Yep. Imagine 20, 25 years ago, if somebody would have told you Google would have been in the Dow or the S&P.
Oh yeah. Who was Google?
Yeah, exactly.
This funny story. So when I was in law school in the last millennium, I was working at an accounting firm, and I remember I was there on a Saturday doing tax returns, whatever. And I remember picking up this. You probably don't. Do you remember the floppy disks? They were like,
of course,
so they were like the big square ones, right? And I remember it was a Saturday. Michigan was playing Ohio State, and Spielman had like 20 some tackle. Just this day. So I remember looking at this disc that said Microsoft on it, and I just tossed it to the side, and I'm like, how are they ever going to compete with IBM?
Yeah.
$1,000 in Microsoft, I probably wouldn't be sitting here today. But
they've split their stock so many times.
Oh yeah, I mean, it was probably 1985 or so, maybe 86 or 7, something like that. So, crazy
Chris Spielman reference. Wow.
Yeah,
I think we have one of those on the show today.
I just remember he had some like crazy amount of tackles that game. But so that's probably like 86 or 87, something like that. But so some of these indexes we use, now you don't really invest directly in the index, right? You could pick either a mutual fund. Most of them are ETFs. I would assume that they follow these. And we also have some products that some of these buffered products you might have talked about in other shows where you can get a little downside protection. We have a couple companies out there, 2 or 3 companies out there. So they might give you, let's say they give you a 15% buffer, which means if whatever index you're in drops 15% or less for the year, that you don't suffer any losses, and they make you whole, and they'll give you a cap on the upside. And some of these products allow you to invest in 2 or 3 or 4 indexes at the same time. So you can pick and choose if you want a little more in the NASDAQ, you want some of the Dow. But I think by far the most of the products are annuities that are out there. For the most part, the big one is the S&P 500.
Yeah, and I mean, there's so many indexes. We have some that will follow retiree spending in certain parts of the country. I mean, they really get granular with some of this stuff.
It's just so hard to explain what those are sometimes. They got some weird names, and then we have spreadsheets and stuff to follow what all those are, and
some of them just track low volatility. So companies that aren't going to do a whole lot one way or the other, just keep you stable.
Yeah. So like in the S&P 500, what Tony's saying, the volatility goes up and down, but there's a sector of it that they call low volatility. So like you might not get the highest gains or the lowest losses, but you don't like to see the big swings. So you can pick a sector that's called low volatility. And over time, I think those do well too. And I think for clients, they, it's less stressful. They don't see their portfolio going up and down. I
Well,
guess
yeah, even if you have a buffer on there,
I
even
guess
if
I
you
didn't
have,
charge my light.
even if you have a protection level on those,
Yeah,
it does help to limit zeros. So say if
right,
you have a protection level and you're like, well, this is a non-volatile index, but I'm getting 100% protection anyway. Why not shoot for the moon?
right,
True, but at the same time, you can prevent zeros with some of those more stable ones because they don't try to do that.
right. And so these buffered products, I think they're really designed to give people a little more peace of mind. They don't want to necessarily be in bank products where they're not earning a competitive rate of interest, but they're not ready to just go full-fledged into the market. So they can pick an index like the S&P 500, and the buffers range from anywhere from 0 to 100, right? So
Yeah.
if you had so basically if you had 100% buffer, what we're saying is that the insurance company will say, look, you can invest in this index. We will protect your downside for the next year. If the market drops, you don't lose a penny. But on the upside, they're not going to give you 100% of the upsides generally. So they're going to give you some type of cap on the upside. I don't know right now what it is, 7 or 8%. But that might be okay for a year. If you're really concerned about the elections and what's going to happen, who gets in, I think there's going to be a little turmoil no matter who gets in. And generally, it'll flush itself out.
Well, a big benefit of those, I think, is tax deferral. A big underrated benefit of those that people don't talk about quite as much is tax deferral. So when you roll a CD at the bank and you keep rolling, you can do that, but you still pay taxes on that interest. We know that when we get those tax forms on people's returns every year. But with the annuity, if you do this in an annuity, any type of annuity is going to be tax deferred.
Yeah. And I think with CDs and things like that, what people don't like about them, they're like, look, I haven't touched the money. Why? Why am I paying taxes on money I haven't touched? But that's just the nature of the game. The insurance, I think the insurance industry has probably the best lobbyists forever in the country. So they were able to get their products tax deferred, and even like life insurance that we use for those that can use life insurance, those are tax free, right? So you can put money in those can grow. They can give you death benefit. They could give you some cash value. Maybe that's another show we do, something on how life insurance can fit in a portfolio. A lot of times people are trying to get out of the taxable retirement. So you can either use Roths or life insurance, but somewhere down the road up front, you're going to have to pay the tax to get it over to the life insurance policy or the Roth.
Yeah, that was a big part of actually the webinar that we're going to be doing on the upcoming election. And your money is not just like, who wins or who loses. It's the tax ramifications, and there's more to this than meets the eye. So that you make a good point about getting the taxes out of the way, paying it when you know a little bit more than leaving it in the unknown. And we call it a ticking tax time bomb when you have all this tax deferred money just built up that you have not paid anything.
Yeah, because you think about it, for most people, if you have a $100,000 IRA, you probably really only have 75% of that, right? Or maybe even 2/3 of it, because it's somewhere down around Uncle Sam. And I don't know who we call the one in Ohio. He's not Uncle Sam, but the governor of Ohio wants some of your money too. So you're going to have the federal tax and the state tax on your IRAs and your qualified money, whether it's 401ks, retirement plans, things like that. So that may be worth a discussion, coming and see how we can lower that tax issue. These tax rates we know are in place until the end of 2025. They will sunset if Congress doesn't do anything. I think they'll do something, no matter who gets in, because they need more. They need more money. But the flip side, people are like, well, if you have less taxes, it should spur the economy because people could spend more, right?
So that's the study that was done that looked at both of them. Yep.
Yeah.
So
would you rather spend your money, or would you rather have the government spend the money? I don't mind government spending money if they were efficient, but they're not very efficient sometimes. And you probably wouldn't spend your money that way. But then there's a lot of issues for that aren't necessarily business issues. Like you got to take care of the needy, you got to take care of the people. And so maybe it's not a fiscally, we're going to spend money, but you got to get, part of the government is to help people who are less fortunate than
Right.
others.
So part of the spending, just like any business or any household, is non-discretionary spending and discretionary spending.
Right. So yeah,
you have a lot of both.
Yeah. So it's gonna be interesting to, we're doing this podcast here in October. We got about probably not even a month, right? Probably about a month to the election. And we'll see what happens. But I think, this is a good discussion on the indices. So if you have questions on it, Tony, how they get a hold of us?
Visit us online.
I always think people just watch us on YouTube, because the other T says you
watch or listen.
I don't know.
But anyway, for those that are listening, obviously give us a Google. We were talking about Google before, but brooksidetax.com. Our Facebook page and our YouTube channel is going to have different content too. You should check us out on YouTube. Aaron's always adding new content
because we're doing
financial, legal shorts now.
Yeah.
We're going to post our webinars up there eventually, but those are on the website. So brooksidetax.com. We get a lot of walk-in traffic. So if you're in the area, you can stop in and say hello, schedule an appointment when you stop in, or of course, do it the old-fashioned way and give us a call.
Okay. All right. Good show today. That's the end of the road to retirement for today. Tony will upload this to our T2 over there. And is he on vacation? I don't know what's he doing.
He's always on vacation.
Yeah, he's got that great radio voice.
He does. You call Gradient. You call Gradient, and you hear Tony's voice on the recording, and so he's made for that. He's meant for that.
Well, he's got a face for radio too. So
as we all do.
So, all right. Well, we'll see you guys next week. It's either Tony or me. We'll be probably talking to T2 next week. So, so have a good weekend and go Tribe.
Thanks.
All right.